Okay, I'm going to be starting a video series on how to trade stocks. This is the first of 6 that I know of so far, and I'd like to go over a couple things before we get started. I'm going to go over some general knowledge in this video on the stock market. So basically, if you don't know anything about the stock market, this will kind of help you get up to speed. So, starting off, a little disclaimer, I don't trade commodities, I don't trade currencies, I don't trade bonds, I don't trade options at all. Just common stock, or stocks. They're also called securities. I'm going to put a little link, probably right here, on the Wikipedia page of the stock market. You can look at that, get kind of an idea of the history of the stock market and stuff like that, so you know how it came about and how it works. Our U.S. stock market is called New York Stock Exchange, NYSE. So I'm going to go over some definitions, and this will kind of help you get up to speed too. A bull market is a market that is going up or is expected to go up. Usually a bull market lasts for about 2 to 4 years and can go over that. It's normally about 4 years. And a bear market is when a stock market is expected to go down or expected to keep on going down. That can last anywhere from 6 months to 2 years. Okay, the next definition is an IPO, an initial public offering. That is when a stock, or that's when a company decides to be publicly traded on the stock market. All right, an index is a measure of change in an economy or securities market. I'm going to put the definition right below me, right about here. Um, but yeah, it's basically just a measure of how the market's doing as a whole. There's a couple indexes out there. The one I usually follow is the S&P 500. That's a pretty good general one. There's the Nasdaq. There's the Russell 2000. There's a couple, and I'm gonna put links to those up here too. Now, when you're actually looking at a stock, there's two numbers that determine. Well, there's three numbers that determine what the stock price is. There's the last sale, which was the last time it was traded. Whatever that price is normally what your stock quote will be on. But there's also something called a bid and an ask. A bid is the highest price that a buyer is willing to pay for a stock, and the ask is the lowest price someone is willing to sell the stock. All right. With that being said, there's two types of ways, or well, there's two common ways of buying a stock. There's what's called a limit order when you say, I want to buy it at a specific price. The other type of order is a market order. That is execute right now. Execute at the best price you can find right now. And that's usually what I use 95% of the time. With that being said, we're going to go over some other definitions, like volume. Now, volume is the amount of shares that are traded in a stock in 1 day or 1 hour or 1 year. Normally it goes daily. It goes, by daily volume. Now that is the number of shares that are sold or bought in 1 day. Normally they're measured in the thousands. Volume is a good indicator on how much interest people have in the stock. If the stock is going up and there's a lot of volume, then a lot of people are interested in it. If the stock's going down and there's a lot of volume, then that generally means a lot of people are trying to get rid of it. So probably time to get out of that stock. Um, but it's also good indicators of other things. Let's say if the stock's going up slowly and there's a lot of volume, then a lot of people will be interested in it, but at the same time they're not quite sure about how high they think it's going to go. So that might be a stock to watch. And there's a couple things I want to go into on general rules for trading stocks. Like penny stocks, for example. Penny stocks is a stock that's worth less than $1 per share. Not worth your time at all. There are people out there that make a lot of money on penny stocks, but they're very, very risky. Actually, I don't trade anything below $10 generally. If the stock is worth less than $10, I consider it too volatile or too extreme. It has extreme changes. Um, let's say Apple, for example. It could be like $400. Now, that's an expensive stock. You won't be able to buy that many shares, right? But at the same time, you're looking for percentage gains, not just how much dollars per share you're going to gain. So a thousand, if you have 1,000 stocks that are worth $1 and it drops by 20 cents, you're going to be losing your mind. That's that's a good chunk of change you just lost. Whereas if you buy Apple or Google or anything like that, relatively expensive stock, and it drops 20 cents, you won't even notice it. You're looking for percentage gains and losses. Now, with losses, um, I generally, if I lose more than about 5%, I sell it no matter what. It's not worth waiting around and seeing if the stock might go back up so you can, make that little bit of money back. Not worth it. Just sell it. Um, you can lose a lot more in the end, like all your money, which the first time I traded stocks, I started out with $500, and I pretty much lost in about a week. I had no idea what I was doing. Um, I looked at CNN money and stuff like that online. I'm like, oh yeah, this sounds good. Okay, I'm gonna dump all my money into that, and then it dropped, and I lost all my money. Well, that's really hit home for me. Kind of makes you pay attention and uh, decide to learn a lot more about what you're doing. Um, so anything more than 5 to 7% at the most of a loss, just get rid of it. Cut your losses because you can lose potentially a lot more. So it's not worth it. Um, with that being said, fuck feelings, fuck emotions, fuck any hopes, fuck any dreams. This isn't about, this isn't gambling. It can be, and you will lose. It definitely can be gambling, but it shouldn't be. And it's easily avoidable. You can, at the least, break even in the market, at the least, which is general knowledge and general rules. You don't have to go out there and lose all your money. And you're not going to get rich tomorrow. Uh, Maybe the next day, who knows? But it's not, the stock market isn't something that you're just going to throw your money into and be like, oh, I'm going to buy this, and then you're going to, you're going to double your money. It's not going to happen. It is not going to happen. I did a lot of research the first 3 months I was trading, and I more than doubled my money in about 3 months. But I didn't sleep, and every single ounce of effort that I put forth in anything had to deal with me doing research on the stock market. Um, I literally did not sleep for days on end. I'd sleep like an hour at a time. It was pretty stressful. But I realized that if you do put the effort in the research, you can make a significant amount of money. Um, Floor traders, the guys that are actually uh, in New York City, those guys live and breathe the stock market. I don't think I could do that anymore. I did it for 3 months and I was dead. I was done. Couldn't do it anymore. So yeah, don't invest your emotions in it. Make rules for yourself and stick to them. If your rules aren't working, refine them. Um, Research definitely takes a lot of work, and there's a lot of terms you're gonna have to learn, a lot of concepts you're gonna have to learn. Stuff like EPS, earnings per share. A lot of people don't know what that means. If you ask someone on the street what EPS is or what earnings per share is, they're probably gonna stare at you blankly. Um, do your research. If you have questions, um, write me. Google knows everything. Trust me. Well, 99% everything. It's pretty close for me.